Hello everyone. Hello everyone. Am I properly audible to all of you? So I hope everything is working fine and we are ready to start. Let me know if you all are able to hear me properly and see the screen properly, this PPT, and then we will start our session. So let me check from here if everything is working fine. Yes. Okay, so it's good. All right. All right. So today we are going to discuss some very important MCQs for the Indian economy and Indian financial system, and we are covering the module B currently. So let us see what all questions do we have today here for you. I personally believe that preparing through MCQs is a more effective way of studying because it helps us to retain the facts for a longer period of time. Now through the questions, it's not just we are doing some marathon series or something where I'm just going to ask the question and look for the answer. No, here my approach is to read out a question, then explain you about that concept, and then we will move on to the next question. So this is going to be my approach for this. Let us start with the first question here. Okay, so I have explained you some definitions of economics. The first question is from that topic, Robin's definition of economics. So the question is, just a moment, let me turn on the pen here. Okay. All right. The question is, which aspect of human behavior does Lionel Robbins' economic definition emphasizes on? Option A, the study of human needs and welfare. Option B, the relationship between the unlimited wants and scarce resources. Option C, the analysis of economic growth and stability. And option D, the study of capital and interest rate. Which of these is the right answer? So write down your answers in the comment section, then I will tell you the right answer, and also we'll discuss briefly about what is this Robbins definition of economics. That is going to help you retain this for a longer period. So let me know if you have any doubts about it, or if you are even if you have not studied this topic, just try answering the question. So this is the question. Let's see who all answered this question. All right, let me check your comments first and then we will move on to the right answer. In the live chat, you can comment your answers. All right. So I'll look for your answers. Okay, so you all can type the answers in the live chat. If you're watching it as a recorded session, in that case, you can just when you're looking at the video recording, you can just type the answers in the comment section as well. So the right answer is option number B, the relationship between unlimited wants and scarce resources. What is scarce? Scarce means the limited resources. Okay, so this Lionel Robbins economic definition emphasizes on the relationship between the unlimited wants and the scarce resources. So this definition highlights that the economy is the science which studies the human behavior as a relationship between the ends and scars. See, what it is doing, this definition that Robinson has given, it highlights that the economics is the science which studies human behavior as a relationship between ends and scars means as in not meaning, scars means which have alternative uses. Therefore the correct answer here is option number B, the relationship between the unlimited wants and the scarce resources. I hope everyone is clear with this and we can move on to the next question. So this is the correct answer, as you can see. Now to get all this PDF and all the questions and answers, everything, you can join the WhatsApp group. If you want the link to that WhatsApp group, I'll share it in the comment section. You just write down in the comment section to share the link of the WhatsApp group, and I'll share it. Okay. All right. Now, some fundamental economic questions. So, which of the following is not one of the basic questions every economic system aims to answer? Let me first see if everything is fine here. Okay, yes. All right. Okay. So, which of the following is not one of the basic questions every economic system aims to answer? Option A, what goods and services should be produced? Option B, how should goods and services be produced and who should produce them? Option C, who should receive the produced goods and services? And option D, when should goods and services be produced? What do you think is the right answer out of these? So you need not to be absolutely correct every time. You can just attempt the question, see if it is right, and even if it is not, you will learn something new with this attempt. See, the right answer here is option number D. When should goods and services be produced? Why so? The basic question that every economic system aims to answer typically revolves around what goods and services to produce, how to produce them, and then how after that who receives them. These are the basic questions. Now, these are the fundamental questions for determining the allocation of the scarce resources. About the question of this when should goods and services be produced, this is not typically considered as one of the fundamental economic question in the same way as timing is often the result of answering the other three questions. Okay. Based on the efficiency, demand and other factors, therefore the correct answer here is option number D. Okay, here you can see. All right, moving on to the next question. Here, this one. The next one is the question is based on microeconomics versus macroeconomics. The question here is, what is the main focus of microeconomics? Option A, behavior of entire economies. Option B, decision making process of individual household and firms. Option C, national unemployment rate. And option D, international trade policies. Which of the following is the right answer? See, this is something that we have discussed in the previous session. I hope that you all have seen that live session. If not, you can find it in this particular channel. Here you can go to the live section, and in that you'll find the previously streamed live session. So it was a day before yesterday then when we conducted this session. You can have a look at that. So the main focus of microeconomics is on the decision making process of the individuals, households and firms, and how these entities interact within the markets. Microeconomics studies the factors like the consumer behavior, then individual labor market, production, or the pricing policies of individual firms. Therefore, the correct answer here is option number B, the decision making process of individual, household and firms. When we are talking about microeconomics, it is at the basic level, the individual level, okay, or the firm level. That macroeconomics, it's about the national employment, international policies, all those things. It's a macro level. Micro level, it is the individual, household and firms, that one. Okay. All right. So the correct answer is option number B. Next question is based on types of economic systems. What type of economic system combines the elements of both capitalism and socialism? Market economy, command economy, mixed economy or traditional economy? This is a very simple question and I expect everyone to answer it correctly. Even if you're not able to do it right now, you can watch the previous live stream and you'll get the idea about what it is about. Okay, so the type of economic system that combines the element of both the capitalism and socialism is called a mixed economy. This system basically incorporates aspect of both the market driven economy, that means the capitalist mechanism, and the planned economy, that is the socialist economy. Okay, so in mixed economy, the private and public enterprises, they both exist, so that means they coexist, and the government and the market both play significant role in the economic decision making process. Therefore the correct answer is the mixed economy, that means option number C. All right, I hope everyone has answered it correctly. Next one. The next question is about the demand and supply theory. So the question is, the law of demand states that other things being equal, there is an inverse relationship between price and quantity demanded. This relationship is depicted as option A, horizontal demand curve, option B, vertical demand curve, option C, upward sloping demand curve, or option D, downward sloping demand curve. Answer this question and also explain why is it the right answer, because it is something conceptual and you need to be clear about the concept behind it. So that's why I'm asking you that you have to tell me why you are saying that this is the right answer. So I'll wait for your answers for this one. Everyone, do answer it. Let me know when everyone is ready for my answers. Okay, I think that we are good to go. So the right answer here is option number D, that is the downward sloping demand curve. Now why is it the right answer? See, the law of demand states that other things being equal, everything else is constant, there is an inverse relationship between the price of a good or a service and the quantity demanded. This means that as the price of goods or services increases, the quantity demanded decreases. किसी भी चीज़ का रेट बढ़ेगा तो अपन कम खरीदने लगते हैं, किसी भी चीज़ का रेट घटता है तो अपन ज़्यादा खरीदने लगते हैं. As the price of something increases, we try to avoid purchasing that stuff. Whenever the price of that stuff decreases, we tend to buy more than what we usually buy, right? So this means we are clear that how it is impacting. So this means as the price of goods or services increases, the quantity demanded decreases, and conversely. So as the as if let's say the price decreases, the quantity demanded increases. Now this reverse relationship is graphically represented by a downward sloping demand curve, and the curve slopes downwards because each point on the curve reflects a lower quantity demanded at a higher price and a higher quantity demanded at a lower price. So clearly, as one unit is increasing, if this particular price is increasing here, so the quantity demanded is going to keep on decreasing. So downward sloping, if the price is decreasing, the quantity demanded is going to be increasing. So that's how it works. All right, I hope that everyone is clear with this concept. So that is option number D, downward sloping demand curve. I hope everyone is clear till now and there are no doubts about this particular topic. Okay, let us move ahead and see what is the next question. Here, correct answer option number D, you can see. Next question is based on the money supply. Now the question is, which measure of money supply includes currency with the public and demand deposit with the banking system? M1, M2, M3 or M4? Write down the right answer Also tell me why is it the right answer, and what is M1, M2, M3 and M4 currency if I'm talking about the measure of money supply. Okay, so everyone do answer it. I'll explain the question again. So, which measure of money supply include currency with public and demand deposit with the banking system? Is it M1, M2, M3 or M4? Also, after answering, explain what is M1, M2, M3 and M4. Okay. You can briefly explain it that okay, M1 is related to this, M2 is related to this, like that. So it is really important because M1, M2, M3, M4 is very important concept. Okay, see, the measure of money supply that include the currency with the public and demand deposit with the banking system is M1. So let us understand what exactly is M1. See, M1 is the most liquid form of the money supply. I hope you all are clear with what is liquid form of some money supply. So this includes the physical currency that is held by the public, that means the notes and the coins, then the traveler's check, then the demand deposit and other deposits against which the check can be written. So it represents money that is easily accessible for the transactions. All right, something that is easily accessible for, let's say you buy something from me, I can easily give it to you, so that like it is easily acceptable or accessible for transaction. Now what is M2? So here right answer is M1. Now the about the next one, M2. So what is M2? M2 includes all of M1. So M1 is going to be there in this M2 plus less liquid forms of money like the saving deposit, time deposit below a certain size, often. So that depends on different criteria, but yes, then non-institutional money market funds. So M2 is used to estimate the money supply that is not just liquid but also near liquid. So it is going to include the liquid as well as the near liquid ones. Okay, so that one also, and it can fairly quickly be turned into cash or a checking deposit. So that is not readily available, like it's not instantly available, but yes, it can easily be converted to liquid form. So that's why M3 adds to M2 larger time deposits, then institutional money market funds, then short term repurchase agreement, repo agreement, and larger liquid assets as well. So this broader category includes slightly less liquid investments that are not readily accessible for spending but can be quickly converted into cash or a checking deposit. About M4, so in M4, not see M4 sorry, pardon. M4 about M4, not all the countries define M4, and its components can vary significantly when we are talking about where it is being used. Generally, I'll give you a general example. Generally, M4 includes M3 plus other components such as the foreign currency deposits and other items that reside in the national financial system but are not frequently used in the everyday transaction. So M1 provides the narrowest and the most immediate form of money supply used for measuring the currency most readily available for transaction. So for this one, right answer was M1. I hope everyone is clear about this. Okay, all right, now let's move ahead. So it is option number A. Okay, all right. Okay, now the next question is here. So the next one is, which measure of money supply include, just a minute, I think it's a repetition of the question. Okay, kindly ignore it. Okay, ignore that one, that was a repetition. So now we are moving to the next question. So next concept, So this question is about the theory of interest. Question is, according to the classical theory, the rate of interest is determined by option A, the equilibrium between the demand for and the supply of money. Option B, the government's fiscal policies. Option C, the equilibrium between the demand for and supply of saving. And option D, consumer spending habits. What is the right answer out of these based on the theory of interest? Everyone do answer. It will keep my energy up if you all are answering. Okay. So let me first explain you about this classical theory of interest. Then we'll talk about the right answer. See. According to the classical theory of interest, the rate of interest is determined by the equilibrium between the demand for and supply of saving. I have told you about this equilibrium in the previous session. So when the demand is exactly the same as of the supply, that point that is the point that we talk about. So if coming back to this classical theory of interest, the rate of interest is determined by the equilibrium between the demand for and supply of saving. So this theory states that the interest rate adjusts to equilibrate the saving and investment in the economy, ensuring that the amount people wish to save exactly balances the amount that the business wish to invest. Okay. So the correct answer out of these is option number C, the equilibrium between the demand for and supply of saving. So the classical view emphasizes how savings and investment in an economy drive interest rate without direct influence from the monetary policy or the consumer spending habits as the primary factor. Okay. So that is about this one. I hope everyone is clear. The right answer is option number C. Okay. Next one. This question is about the Keynes liquidity preference theory. Question is, according to Keynes liquidity preference theory, the demand for money is primarily driven by option A, the transaction, precautionary and speculative motive. Option B, the consumer price index. Option C, the production cost of money. And option D, the international exchange rate. Okay. What is the right answer out of these? Write down in the chat box. Sorry, was I not audible? Okay, it's fine now. All right. See, according to the Keynes liquidity preference theory, the demand for money is primarily driven by the transaction, precautionary and speculative motives. So this theory suggests that the individuals hold money for three main reasons. You're holding money for three main reasons. First, transaction motive. That means we need to make some daily transactions. Then the next point is here, precautionary motive. That means people hold money for unexpected needs. Okay. And the third one is speculative motive. That means people hold money to, or you can say cash, to take advantage of the future changes in the interest rate or the prices of the bonds and stock. So the correct option here is option number A, that is the transaction, precautionary and speculative motive. So this framework basically explains why people demand liquidity or money based on their need for transaction, safety and future investment opportunities. Okay. So this is the right answer for this one. Any doubts till now? Everyone? Any doubts? So you can write down in the chat box if there is anything that you're doubtful about or anything that you want me to explain in detail. So we can even discuss that particular concept in more detail. Okay. All right. So I think we are good to move to the next one. Let us move ahead. Okay. Okay. Then after this question, we'll take a small break of 5 minutes so that you all can refresh. Okay, this is the option number A, right answer. The next question is impact of economic policies. So, which macroeconomic policy is primarily concerned with controlling inflation and stimulating investment by managing the interest rates? Option A, fiscal policy. Option B, monetary policy. Option C, trade policy. And option D, wage policy. What is the right answer here? And why is it the right answer? Everyone do answer this question. Okay. See, the correct answer here is option number B. Why? So that is the monetary policy. Why? See, monetary policy is primarily concerned with controlling inflation and stimulating investment through the management of interest rates and the money supply. We hear now that CRR is this much, and the Reserve Bank of India has made these changes to the policy, and because of that, the liquidity has increased or decreased. All that we are going to talk about in the coming sessions. But for now, understand that monetary policy is primarily concerned with controlling inflation and stimulating the investment through the management of interest rates and the money supply. So the central banks like RBI and the Federal Reserve in the United States, they use the monetary policy tools like setting the interest rate at which the bank can borrow from each other or from the Reserve Bank of India, or whichever the central bank we are talking about, and through the open market operations that involve buying and selling of the government securities. And this is also a question that was asked in the year I appeared for this exam. So that was what is this open market operation? Options were there. So that is the that involves the buying and selling of government securities. So by adjusting these rates, the central bank can influence the inflation and economic activity. Lower the interest rate. Basically, what happens when the interest rate is lower? It typically reduces the cost of borrowing. Let's say the interest rate was 9%, now it has fallen down to 7%. Okay, so that means now borrowing is cheaper for me, so it encouraged the spending and investment. That means if let's say I got an idea that earlier the home loan was at 9%, but now it is at 7% for a certain time period, so I may be interested, okay, I should buy a house. This is the perfect moment for me. Why? Because the interest rate has decreased, so it is going to encourage spending and investment, and it can help stimulate the economy. While higher rates can help control the overheating economies and inflation. When the interest rates are higher, people would be willing to borrow less. So and they'll be having lesser money in their hand. If they have lesser money in their hand, because of that, they would be willing to spend less, which is ultimately going to help us control the inflation. Okay. The fiscal policy, trade policy, and wage policy, they impact certain some other economic areas, but they do not primarily deal with the interest rate management and direct control of inflation. Okay, so if the question is about controlling inflation and stimulating investment by managing the interest rates, that is definitely the monetary policy. I hope you are clear with this one. Now we'll take a small break of 5 minutes, and then we will resume the session. So by that time you can attempt the next question. Here it is on the types of inflation. You can attempt this question, or you can just have some water, relax, and then we'll resume since it is already half an hour. So after half an hour we take breaks of 5 minutes. Okay, are we good to go? Okay, all right. So let us understand what is this question. Keynes liquidity preference theory. So the question is, according to Keynes liquidity preference theory, the demand of money is primarily driven by. So this we have already discussed, that it is driven by the transaction precaution and the speculative motives. Okay. So I'll just give you a revision of this. Transaction motive, I've explained that we need money for daily transaction. Then precautionary, if there is any urgency unexpected event for that. And speculative, that is we hold cash to take advantage of future changes in the interest rate or the bond prices. Okay, all right. Next one, which macroeconomic policy is primarily concerned with controlling inflation? This is also something that we have talked about. I think it has started from the first slide. Yeah. Yes, okay. So we were discussing this question, types of inflation. So the question is, cost push inflation is characterized by option A, decreased demand for goods and service; option B, increased aggregate supply; option C, increase in cost of production and influencing the overall prices; or option D, lower taxes and increased government spending. What is the right answer out of these? So try to answer it, everyone. Please do try to answer this question. See, the right answer here is option number C. So an increase in the cost of production and influencing, and that is something the increase in the cost of production influencing the overall prices is the right answer here. Why so? See, cost push. These are the terms that we study in the theoretical part, but now I am going to explain it here. So, what is this cost push inflation? It occurs when the cost of production inputs like the raw material, wages, all of it increases, or some of it increases, or any of it increases. Okay, leading to the producer to rise the prices in order to maintain their profit margin. If something was there which I was producing for 100 rupees and I was selling at 150 and I was getting a profit of 50 rupees, now let's say I require 120 rupees to produce that stuff, so I'll have to increase the price in order to maintain my margin, right? I cannot sell it still at 150. So this inflation type does not necessarily involve the change in demand or the aggregator supply in sense of quantity. So it actually implies a decrease due to higher production cost or the fiscal policies like tax and government spendings. These are not related to it. Okay, so that is the right answer. So what is this cost push inflation and what other types of inflation are there? I'll just give you a brief so that you can understand about it, and it will be more beneficial for you that we are covering this. So the cost push inflation is one of the primary types of inflation, which is characterized by the rising price due to increased cost of production. What can lead to it? What are the key factors? So it includes the higher cost of raw material, increased wages, and more expensive energy or capital cost, something like that. So when the producers face higher input cost, they often pass these costs on to the consumer in the form of higher prices in order to maintain their own margin. Now, apart from this cost push inflation, there are certain other types of inflations as well, like the demand pull inflation. So what is that? So this occurs when the demand for goods and services exceed their supply. More demand, less supply is there. So which can happen due to increased consumer spending, government expenditure, or the investments. As the demand outstrip the supply, the price is going to rise. Since I have 100 units, but earlier there were 80 people willing to buy. Now there are 1000 people willing to buy in the that's a very big number. But if now there are 200 people willing to buy, so I'll have to increase the cost. Okay, Then the next one is built-in inflation. So we also call it as wage price inflation. This result from the adaptive expectation of the workers who demand higher wages to keep up with the rising living cost. Okay, so the employers pass these higher wages cost on to the consumer in the form of higher price, which may lead to wage price spiral. Okay, so these are there, but there is a lot more to study about inflation that we'll cover in the coming sessions. So each type of inflation has a different cause, and it can be influenced by various economic policies and conditions. So that is understanding the types of inflation helps us to apply the appropriate economic policy to control it. Okay, that is about this one. I hope this is clear to everyone. So the right answer here is option number C, that is here. Okay, the next one, market structures and macroeconomics. So which market structure is categorized by a single supplier, unique product with no close substitute and higher barrier to entry? I hope it is visible. Actually, this size is a bit less than other questions. So I'll read it out again for you. Which market structure is characterized by a single supplier, unique product with no close substitute and high barriers to entry? Option A, perfect competition. Option B, monopoly. Option C, oligopoly. Or option D, monopolistic competition. What is the right answer here? I'll increase the font size from the coming questions, but for now, just bear with me. Okay, and if you're facing difficulty, you can ask me again to read or to increase the font size right away. See, the right answer here is monopoly. So monopoly market structure is characterized by a single supplier that dominates the entire market, offers a unique product for which there are no close substitutes. So this is protected by high barriers to entry that prevent other firms to form, or you can say to be a part of that competition, or from entering into the market and competing. It is stopping them. Okay, and what about this perfect competition, monopoly and oligopoly and perfect competition and monopolistic competition? What are these? Let us understand that. Perfect competition, as you can read from the name, definitely in this particular question you could have eliminated it easily. So perfect competition is, it is characterized by many small firms that sell identical products where no single firm can influence the market prices. If one firm has increased the rates, I know I have other options, so it is not going to rise the rate that drastically. So barriers to entry is low in this case, allowing the new firms to enter and exit the market freely. Let's take example like wheat or corn. It's not like if one farmer has decided to sell their produce at a higher price, the whole market is going to be impacted. No, so that is a perfect competition. Then monopoly, as in this one, so there is only one firm that can dominate or the entire market with no close substitute for its products, leading to high barriers to entry. So this firm has significant control over the prices because it is the only one available. So if we have to buy, we have to buy from this person only. So if they increase the prices, we have to pay higher prices. We have no control over it. So example, you can say some utility companies in a region, where they are the sole providers. Okay, and then there is oligopoly. What is this? So this market structure features a few large firms that dominate the market. So they sell either the identical or differentiated products. Oligopoly can lead to strategic behavior among the firms as each firm's action affect the others. So high barriers to entry often protect these firms. Example like automotive and the airline industry. I cannot say na if Air India is too costly, so I'll open my own airline. No, there is the high barriers to entry are there, na. So they protect these firms. And then what is monopolistic competition? So this market structure has many firms that sell differentiated products which are similar but they are not identical. So these firms can exert some control over the prices because of product differentiation. So barrier to entry are relatively low, leading to many firms entering and exiting the market. Some example like restaurants, then we have clothes store, clothing stores, right? Then hair salons, these are there. So each of these market structure varies in the terms of number of firms in the market, the type of product sold, and the ease with which new firms can enter the market. Okay, I hope we are clear till this point. Any doubts, anyone? Any doubts till now? You can write it down if you have any query, any doubt, anything that you want to ask. So we are clear till this point, right? Okay. Okay, I think everything is working fine. We'll move on to the next one. Correct option B, monopoly. Okay. Now, now I'll just switch off the camera because I can see there is some it's freezing, the video is freezing, so that is going to distract you. Okay, all right. The next one, let us see. The GDP deflator is a measure of which of the following? Total corporate profits within a nation, the level of prices for all new domestically produced final goods and services in an economy, consumer and business spending in the economy, or the change in stock market values. What is the right answer out of these? I'm expecting everyone to write down their answers even if they're not sure of the right one, because it is going to help you understand the concept and retain it better even if you have written the wrong answer. Okay, all right, so let us move on. So the right answer is option number 2. So the level of prices for all new domestically produced and final goods and services in an economy. See, the GDP deflator is a measure of the price levels of all new domestically produced final goods and services in an economy. It is used to convert the nominal GDP into the real GDP, which reflects the volume of production independent of the price changes. So this allows the economist and the analyst to compare the economic output of different time periods without effects of inflation. Okay, I hope we are clear till this point. So the option which is correct is option number B. Next question is about the velocity of money. So the question is, the concept of velocity of money refers to option A, the rate at which the money is exchanged from one transaction to another, option B, the pace at which the central bank prints money, option C, the duration it takes for money to double in value through interest, or option D, the inflation rate impacting the real value of money. What is the right answer out of these? So everyone do write your answers. All right. So the right answer is option number A, the rate at which the money is exchanged from one transaction to another. So the velocity of money is an economic concept that refers to the frequency with which a unit of currency is used to produce domestically produced goods and services within a given time period. So it is a measure of the economic activity related to the circulation of the money supply. All right. Okay. So I think we have covered a lot of questions. I have more questions regarding the elasticity of supply, then Keynes versus classical economics, measuring unemployment, price elasticity of demand. So we are going to discuss all of it in the coming sessions. For today, I think we are good to go. So I hope these questions were beneficial for you. I have included some super important MCQs, so do watch it carefully. If you want this PDF, you can write down in the comment section.